So we're going to spend about an hour talking about GAAP, Generally Accepted Accounting Principles. And is that good? Okay. So I'm April Downing. I'm very fortunate to be the CFO for WP Engine. Thank you, my team back there. I'm also the unofficial head of people. I have a passion for both money and people, and sometimes that gets very conflicted in my role. I've raised over $200 million in capital. Everything from startup to taking a company public. Everything from financing with debt to having someone have a total belief in the company and provide money with no strings. So I've learned a lot. What we're going to go over today is some of the options around funding. I'll share a little bit of experience too along the way. But first, a question for all of you. How many of you have been in a situation where you have not had to worry about cash? Okay, we need to talk. How you ever did that, we need to talk. The other thing, right before I get started, I'm just going to remind everyone, help us promote WordPress and entrepreneurism. Hashtag Prestige, CONF, is the hashtag. So anyone who is on the Twitter sphere, please make sure that we help promote it because it really does help all of us from a visibility perspective. So first of all, how do I know if I even need more cash? Before you even think about where you're going to get it from, how do I know if I'm going to need it? Well, a lot of that has to do with the cash flow of your business that you already have. How stable is it? Is it something that you know that you have kind of a stable cash flow that you can count on? Which then gets to the predictability of your cash. A lot of times when we're growing businesses, there can be ebbs and flows in the business. The predictability of that makes a really big difference on what kind of funding you need and how much you need to get. Another part of it is how are you planning to grow? Are you planning to just kind of keep it going at a slower pace? Do you have some new initiatives and investments that are going to change your cash flow needs? These are all things that you need to be thinking about. Stage of the business is another one. Early on, you may think you need a lot of cash, but I promise you, early on is the time to probably be a little bit more conservative about that. Later on, when you've proven out a baseline business and you're ready to make some other investments, well, that stage of the business, maybe you want to be a little bit more aggressive. And please don't ever forget about cushion to fail. So much of the time when we go out and we raise money, we go, oh, I need exactly this amount of money. You don't leave yourself the ability to fail. We all fail. That's okay. But you don't want that failure to be something that ends up throwing your business totally out of whack. So what are the types of funding? So there's basically 4 types of funding we're going to talk about today. There's good old-fashioned bootstrapping, the ever popular now crowdfunding. You have equity funding, and we'll talk about the different types of equity funding. And then, of course, debt, and we'll go through some of those different types. So bootstrapping. Why would I want to bootstrap my business? Let's say that I'm getting going, or maybe I'm a serial entrepreneur, and I don't really want to take money from someone else. I don't want to give up ownership in my business. There's a lot of really, really, really successful companies that have done this. Who here's heard of Tough Mudder? So Tough Mudder started with some guys who were trying to get the first one off the ground. They didn't know if they were going to make it. They started with about $5,000. Well, we all now know they not only made it, but they're in one of the top fast 500 companies that have actually been out there and gone public. There's also a company called Analytica. They're number 81 on the top 500. And GoPro, who knows what GoPro is? So GoPro, wow, they had a hard haul. They decided to bootstrap that business, and it took over 10 years, a lot of pain, a lot of suffering, but they actually went public this year for almost a $3 billion valuation. So it can happen. A lot of people who bootstrap, again, they may be serial entrepreneurs, so maybe they're putting some of their own money in. Others leverage credit cards. They may leverage their savings. So it can be really, really risky around that. But there are a lot of successful companies. Out of the Inc. 500, 60% of them started with $10,000 or less. So it happens. It's actually usually a really good first step in growing a company. But we also have to be really realistic about the ability for startups to be successful. After 3 years, only 60% of most startups are still around. That number drops dramatically down to 35% after 10 years. So there is quite a bit of risk associated with it. Oh, that button didn't work, sorry. Crowdfunding. Oh, this stuff's fun, isn't it? Who wants to go on Shark Tank? No. All right, we got one. Sounds really super stressful to me. So crowdfunding is a new initiative that came into play just back in 2012. Crowdfunding is typically for businesses that want to try out a new product strategy. It works best for product companies, and it can be wildly successful. There's 2 Kickstarter programs that stand out as just being phenomenal. One is Coolest Coolers. They got $13 million against a target of 50,000. Wow. Pebble iPhone, which is an Android watch thing, Android and iPhone watch, $10 million against a target of 100,000. It can be really successful. But if you look at the statistics around it, and if you're really trying to fund a business, it's typically not your best avenue. Again, maybe if you want to try out something. Only 43% of companies reach their goal on their programs. And the average that people raise is only about $7,000. So again, it's maybe something good to test out, but not really viable from a future funding perspective. So then you get to equity funding. And there's lots of different kinds of equity funding. You've got seed funding. You have the ever-present Series A, B, C, D, go on down the line. And then you also have going public. So what does it mean to have equity invested in your company? What that means is that you're giving up some ownership in your business to an investor who's coming in. Typically, these investors take something called preferred stock. Who here has raised money through preferred stock? Just give me a... Okay, so preferred stock has, as you would think, has preferences over the common shareholders of a business. Those preferences could be anything from information rights, so I get to hear more about the business. It could be I get representation on your board. They could even have blocking rights against things that you get to do in your business. If you wanted to sell your business, let's say you're a founder and you wanted to sell your business and you bring in a preferred shareholder, they can actually block you from being able to do that. They also have liquidation preferences. So let's say that you were being wildly successful and then you wanted to go public. Well, that investor can actually have some say into what valuation. And I know you're nodding your head. You're like, yep, I got it. They can have a lot of control. They also, when you think about the order of how money flows through an organization, let's say you did have a liquidation event. Let's say it was a very successful one. First, all of the debts have to be paid off in the business. Then your preferred shareholders get paid back. And oh, by the way, sometimes they negotiate to get paid back more than one time their money. Then after those things happen, then the common shareholders get to participate in that flow of that money. So it's really important that you understand the implications of getting equity funding into your business. So given all of that, do I really want to bring an investor in? Do they bring in more things than just money? Well, they actually can. There's a lot that they can contribute into your business. First, just experience with growing a business. Let's say that you're a new entrepreneur. Or maybe you've been an entrepreneur before, but maybe you haven't brought your business to this level before. So you really need someone who's got some experience who can help bring that to the table. Industry expertise is another one. I get asked a lot, does my investor have to know my business? Do they have to be an industry expert? Not necessarily. Depends on what you're wanting that board member to do or what you want that investor to do. But it definitely can help. Connections to other companies. Most investors come from an institution that has invested in other companies, and they talk about those other companies as portfolio companies. They have really deep relationships with those portfolio companies that they can actually help a lot in bridging new relationships with those people. So that has a lot of value. Gap fillers. Say you're early on, or you could even be later stage. You've got an executive team or a management team that is rocking along, but you may have some gaps in it. Maybe you don't have someone in sales who has really sold at that kind of size and scale of business that you're trying to get to. Or maybe it's a marketing person who perhaps you need a gap for someone who really knows how to take strategy to the next level. Or maybe it's a CFO. Maybe you have a CFO, but you don't have someone who's taken a company public before and you think that you're on that pace. So there can be really good gap fillers for the management team that can help. And then the ever-present and all-important, because every business is really only about its talent, investors can be really, really good at helping connect you to talent. I can tell you we have one gentleman who's he was a potential investor. We built a really good relationship with him. Just in the last year, he's brought us 2 top managers in our organization. People we would have never been able to get if it weren't for him. And of course, then those people bring in great people who bring in great people. So those are some of the benefits that you can get from bringing in a new investor. Okay, so now we're going to talk about the 3 things. So I said seed funding, VC, kind of series A, B, C, and D, and then going public. Seed funding typically comes from 2 different sources. You can do friends and family, or you can do angel investors. So friends and family, I think, goes without saying what that is. You've got people who believe in you, or they like you, or they love you, and they want you to be successful and happy and all of that good stuff. And you need to get off the ground. So you go to them and you say, hey, I've got this new thing. I need a little money. Just slip me some cash on the side. Hey, Mom, don't tell Dad. Don't borrow money from people who can't afford to lose it. I promise. It gets into a really awkward situation. The other thing, if any of your friends or family are investing, is you need to make sure that you reveal the risk to them that this money is not coming back. The other thing is really make sure that you treat it formally. I know it sounds silly to go spend $5,000 or more on legal fees to get money from friends or family, but I promise you it will help you in the end to make sure that everything is formal, everything is documented. The other thing is that helps them realize that they are investing in the business. Try to remove you as a person as much as possible and make it about the business. Ensure that there's transparency as to what stage the company is at, how it's doing or how it's not doing, so that they can have some understanding of how far along are you going, are things tracking well or not. So angel investors. Angel investors are typically very wealthy individuals. Sometimes it's a group of angel investors, something like a Shark Tank or the Dragon's Den, that they get together and they'll invest. They have to be accredited, which means that over the last 2 years, they have to have a net income of income of $200,000 or more. They have to have net wealth, or they have to have net wealth of over $1 million, or them and their spouse have to have income of over $300,000. So they have to be accredited, which basically just means that they can lose some money and it's okay. There's lots of companies who have had angel investors, Google, Yahoo, PayPal. All of them leveraged angel investors early on. These are typically for companies that are pre-revenue or very, very early on, that things are really still getting proven out. And from an angel perspective, there's over 300,000 angels in the US alone from which you can derive some money. Series funding, venture funding. The first series that you raise is Series A. The second is B. The third is C, and you kind of get my drift. You can do things called follow-ons. So maybe an investor comes in a Series A, and then very quickly they follow on with some additional funding. They can call that a follow-on. So that would be like an A1, an A2, an A3. You get where I'm going with this. There's a lot of money that flows through VCs into just the U.S. So last year alone, over $48 billion funded over 4,300 companies in the U.S. Of the first-time funding, only about $7 billion flowed in for about 1,400 companies. So about 15% of the funding last year went to first-time companies. That's because your first rounds that you raise are typically much smaller. A Series A generally is about $2 million to $5 million in capital from a VC. The farther along you get, typically the bigger those amounts get. So that sounds like a really good idea, right? Okay, I'm going to go get money. So what are they going to ask for in return? Well, they're going to want to have board representation. So they're going to want to create a board, and they're going to want to have representation on that. They're also going to be looking for returns on their capital. Typically, they're looking for a 5x return on their capital, and sometimes those investment horizons are just 3 to 5 years. That means within 3 to 5 years, those investors want to get 5 times their money back. Now, that's what they want, and that's what they're looking for when they invest. By the time you get to a Series C, okay, and usually by the time you get to a Series C, generally your business is probably at about a $25 million run rate. They're going to want to be able to see a pathway to a $1 billion valuation for your business. That's not always, but for the most part it is. So a Series A, when you look at the bands of investment there, that's typically somewhere between $1 million to $3 million of revenue. By the time you get to Series B, it's typically around $13 million to $15 million. Series C, typically the business is throwing off $15 million or more in revenue. And then once you start getting to D's and E's, again, depending on what's happening with the business, that's typically when you start looking at, is this going to be a public company? Can this company make it to that? Valuations. Valuations are a funny thing, and they change quite often depending on what the investment environment is like. If I have trailing 12 months revenue that I know, I typically would look for, in this environment, about 5 to 8 times that for my valuation. So what does that mean? That means I take the last 12 months of revenue, and I multiply it by either 5 to 8 times, and that's typically what my pre-money valuation is. You also measure it on forward 12 months, although that gets a little riskier because, of course, that's in the future and hasn't happened yet. And that's typically somewhere from 3 to 6 times forward 12 months. Now, I'm going to tell you that all of it is about negotiation. All of it is about how your business is doing. All of it depends on how much money you're losing or making or what the market size is. All of that varies. But generally, those are some kind of boundaries that you can look at. Now, how successful can you be at raising money? It's hard. There's a little less than 800 or 900 different VCs out there. Typically, they'll look at over 100 companies and fund 2. It is a long road to hoe. But, again, from a capital exposure, it can be very helpful. So then IPOs. Why would I want to do an IPO? Well, it's sexy, right? No, Liquidity. Liquidity of your existing shareholders is one of the biggest reasons to do an IPO. It does afford you access to additional capital in really big ways. It also enables your founders and your employees to start participating in having a public market for your stock so they can go out and make money too. It also affords you the ability to have follow-on rounds, so they call those secondaries, where you can still raise more money out in the public market, even beyond the initial public offering. And visibility. It's a big part of it. When you go public, there's a whole lot of hoopla. You're looked at in a different realm. It's a really big deal. So what's the average size of a company to go public? When should you go public? My general thing is, until you are at least $50 million in recurring, predictable revenue, don't even think about it. The average median revenue is about $100 million, but that's going to vacillate so much between the different types of business models that are out there. The median offering size is $111 million. That means that when you go public, the average size is over $110 million from the amount of money that you raise in your IPO. Profitability is a funny thing. If you look at how many companies go out and do IPOs that are profitable, there's not that many. You can see only 56% of companies that go out are actually profitable. Again, there's a correlation between what is the cash flow needs of your business, what kind of business are you in, because I can tell you, a services business pretty much has to be profitable. Tech businesses, you bet on the come. So they say, you're losing $20 million, you're losing, $100 million. It'll all come. So a lot of it depends on the type of business that you're creating. Number of companies that IPO each year, there's less than 200 of them. So you can just see there's not like a plethora of folks going out there. There's a lot of cost to being a public company. Most companies, the earliest they would go public, or the average is about 11 years. And it costs over $3.3 million just to get ready to go public. And those are direct costs. Then add on to it that you have to change up, usually you have to change up your structure. You got to add what they call public company board members. Those people who they think are so accretive that they have to be on your board and they're helping make things happen, which they do. They do. You have to do, who knows what SOX is? SOX compliance, yes. SOX compliance requires you to do a lot of documentation across your business, lots of compliance, lots of checks and balances to make sure that you can be a public company ready. You also have to make organizational changes within your company. So it's not that you just look up one day and you go, I'm going to go public and raise $100 million. There's a lot that you have to do to get there. On average, it costs over $2 million incremental each year just to be a public company. So there's lots of benefits to it, but you have to make sure that you're weighing against the costs. So how do I select the right investor? First of all, always be closing. Anytime you meet with an investor, you don't ever know if they're going to think you're sexy or not. I promise you, you always, even if you don't think they're sexy, you want them to think you're sexy. They go off and they talk to other people. The other thing is, a lot of times you'll go into a meeting with a potential investor or talk to him on the phone before, and you may go, I don't know if I'm feeling it. You may be amazed that once you actually get engaged with that potential investor, you may go, why didn't I see this before? It's a perfect match. So always be closing. You have to understand how important their knowledge of your business is. At the very least, the goals that you have for your business need to be shared not only with the partner that's investing in you, but also his firm. I've been in situations before where we had an investor come in, someone who we vetted and knew really, really well, and that investor was no longer with the firm within a short period of time of investing in us. it's really important that the next person who comes in to sit on your board, that they share the same values and goals as that partner that you brought in. So make sure that the firm is also behind those goals that you have. You need to look at what is the value that you're trying to get from that partnership, from that investor in that firm. Remember before I talked about what are the different things that they bring to the table? Make sure that you really march up. What is it I'm looking for, and what can they deliver? Chemistry matters. It's like getting married. It's actually easier to get divorced than it is to have an investor get out of your business. So chemistry really does matter. Who's heard of dumb money versus smart money? Yeah. Dumb money. Dumb money is, I just want the cash. I don't care what comes along with it. I just want the cash. Smart money is, I need the cash. I know how I'm going to put it to work, and this investor is going to help me be more successful. So make sure that you're getting smart money. Check references. You would think that that would go without saying. I'm about to have someone put money into my business. They're going to come onto my board. They're going to sit there at board meetings with me every single quarter. I'm going to talk to these people several times a month, probably, but I don't check references. Check references. And do back channel, I promise. Strategic investors. This is something that a lot of people don't delve into very often. So what this means is I've got a potential investor coming in, and maybe they're another company, and they want to make a strategic investment in my business. Those can work out really, really well. A lot of times those are actually precursors for acquisitions. So a much larger company comes in, perhaps they put in money into you because you have something unique or because you can be more efficient and effective at building it or delivering it. And so they put an investment into you. It's actually accretive to their business as well. A lot of times they'll put that money in. While there is typically a hands-off approach to that because they can be conflicted, sometimes they still want to remain pretty invested in the business. They can be great things, but I will tell you, depending on what your business model is, it can also impede your ability to build relationships with companies that may be competitive against that strategic investor. So just be really careful when there's another company that's coming in that wants to invest in you. What does that get you? And what can that put at risk from other potential relationships you may want to build? Oh, debt. There's so many different types of debt. Venture debt. Venture debt feels a lot like equity funding, except they don't take ownership in your business, and they give you a longer time to pay it out. So typically, they might even give you up to 3 years to pay out this venture debt. A lot of times it's formula-based. Sometimes it's not if it's a shorter term, but it feels more like equity. An AR line. So every time I'm driving to work on the radio, I hear this, hey, do you want to fund your business? Do you have cash flows? Do you have accounts receivable? We can fund your business with your accounts receivable in less than 10 days. And I go, wow, that sounds really great. What does that mean? What that means is if you're driving receivables in your business that are predictable, that have been proven to be collectible, that they will actually fund it. That time between when you bill that customer and when you collect it, that's the amount of time that they'll actually fund. But it's at a really, really deep discount. Asset loans. Pretty self-explanatory. Basically, they're loaning you money that's going to be collateralized by some assets that you're buying. And typically, this is for really capital-intensive businesses. I actually haven't done very many of those. An SBA loan. A lot of people go, oh, I'm a small business. I can go get a loan. Well, the thing that's kind of crummy is to get an SBA loan, you actually had to have already been in business for over 2 years, and you already have to be cash flowing. So sometimes it can be good for some additional investments that maybe you want to make, but it still is pretty hard to get, at least for early on. And then convertible debt. Convertible debt is done a lot of times by angels, sometimes early investors, And it basically says, I'm going to give you either for a small round or maybe what they call a bridge loan, a bridge to a bigger financing. I'm going to give you some money, and I'm going to convert that money into equity once we do that later funding, and I'm going to get a premium. So basically, I'm going to get about a 20% premium on top of that. It's actually really effective. There are some blowbacks on that. If you don't do funding, then you do have this debt that you still have to pay out. So it can be a little complicated, but it works pretty well. And then really fast, because I'm right at about time and I want to make sure that I can answer any questions that you guys have. These are just some of the lessons that I've learned. Leverage technology incubators. Who here has been, I heard a lot of people talking about co-working. Technology incubators are wonderful places to learn, build relationships, and leverage other companies, what they've got connections-wise or values-wise or everything like that. Plan for success and paper for failure. This is really important. It's really easy when things are going great to just think that things are going to keep going great. But I'll tell you what, I spend a lot of time thinking, what are all the things that can go wrong? If I'm not here, if our CEO is not here, if one of our board members isn't here 3 years from now, how do I make sure that we're set up for success? And that's making sure that you think of all the scenarios of failure. Don't raise more capital than you see fit. The general rule of thumb that I follow is do a financial forecast. Realistic. Look at what the growth initiatives are. Look at what the investments are. Figure out what you need for 18 months, and then add anywhere from 20% to 50% on top of that. And that's a good marker. You can raise too much money. And then understand the implications of having an investor. What kind of rights do they have? How can they change how you run your business? What are the ways that they're accretive in your business, and how does that measure against some of the other things that you have to contend with? Establish a banking relationship early, and the follow-on, get a facility, a debt facility in place when you don't need it. This has saved me so many times. I believe in getting, for me, I've been in tech for 20 years. I believe in getting bankers who are tech savvy and have helped other tech companies. I believe in building relationships with them. And when I don't need money, that's the easiest time to get money. So put facilities in place early on. Defer long-term leases as long as you can. It is much better to sublease than to be looking at a 5-year lease that either is too small or too big for your business. I promise. Don't make long-term commitments, even if you get a good discount early on. You don't know what's going to happen in your business, and you need to be flexible. I don't care if you're getting a 20% discount. Early on, just take it. Pay what the cash is. Keep that flexibility. And then transparency. I hate the word transparency. People use it as an excuse for sharing information. But information without context, information without education, doesn't mean anything at all. So whether it's friends and family, whether it's an angel investor, or whether it's a VC, or whether it's in your S1 when you're going public, make sure that you are transparent, but you're providing that context and that education around the numbers you're providing. And with that, I will turn it over for any questions. No questions?
No, there are some.
Hey, April. How you doing?
I'm good. How are you?
Good.
Good.
So, what's the best time to start looking for money for the first time, right? Like, what's the story you're trying to tell to get the most value, but
Yep.
also kind of set yourself up for success?
Sure. So the basic question, just repeat it, is what's the best time to start looking for money? When do you want to start bringing it in? For me, it's really about what kind of business are you driving and what kind of margins can you expect to get. So, and I have life in both services world and software world. For services, for me, generally I like to see some predictability of that base around a services business and some kind of typical margin that I can see that I'm going to get around it. And then making sure that I articulate what is that additional investment coming in to do. Sometimes it's I'm going to invest in technology, and so that's it's its own little kind of thing in its own little world. I'm a big believer in if I'm running about a $2 to $3 million business already, and let's say I'm bootstrapped, then if I see, the ability to get much better, I'm going to go invest some money, but not a lot. Because to your point on the valuations early on in a business are obviously much, much lower. So if I can build more stability, if I can build more proof on my history, then my valuations are going to be bigger. So let's say I'm a $3 million business and I'm ready to make it to the next level. I'm going to go raise maybe $1 million to $3 million, but that's about it. And then I'm going to look at my valuations post that I'm going to say, okay, can that take me to that next level? Can it take me a year? Can it take me 18 months down the road? So that then I've proven out more, I've grown more, so that then my valuation's much better. Does that help? Okay, good.
Quick question on the investors and when bringing them on and the process and the dynamics of the negotiations and whatnot. What would you recommend be some of the pitfalls that you look at in terms of, you talked about, preferences and the impacts and voting rights and things like that. What would you think would be like the biggest things folks should consider, like big showstoppers for you?
Sure. So the big showstoppers for me, one is board representation. It's always really important to me. When you talk about board representation, that means, so let's say an investor's coming in. And let's say you don't even have a board yet. And you're like, oh gosh, we got to put a board together. I don't ever want that board member to have a majority on the board. I always want to make sure that there's what you call independent board members. In other words, they aren't investors. Independent board members that will weigh it. Let's say 2 to 1 if you can. Let's say you're creating your first board. It could be as small as 3, with 1 being an institutional investor. And then once you get bigger, say 5, I still only want, as long as I can, an institutional investor to have 1 board seat for just that institution. It's not atypical for once you get to a certain size of them investing money that they may want 2 seats, but that second seat has to come with some still independence. I don't want 2 institutional investors sitting on the board at one time. So that's number 1. Number 2 is preferences, what we talked about. So when we talk about preferences, that means what do they get over the common shareholders? When I first started in tech, it was normal that a venture capitalist would get paid back 3 times their investment before the common shareholders started getting any money. Nowadays, it's more typical that they get 1 time back. So in this day and age, I think you can really push for 1-time return before they participate with the common shareholders, and that's one thing I would look at. The other thing is blocking rights. So blocking rights means, what does this shareholder get to block? What are some things that they can say, no, you can't do that? A lot of that has to do around IPOs. What is the value that you have to have for an IPO? Some of it is change in control. So again, when I look at the board composition and I look at those preferences, those are the things that I kind of weigh around. So those would be the 3 things.
Next question.
Thank you very much for the presentation, April. It was great.
I'm happy to be here. Thank you.
What's the so you've done a lot of raising money. You've probably sat on both sides of the table, and you've probably been sitting at times going, "Why haven't you asked me that? Why aren't you asking about this? It's right in front of you." So, what are the things typically a first timer is going to miss, and the questions that they just aren't going to ask because they're afraid or they don't think of it? Like, I'm sure there are a lot, but the top 2 or 3.
Yeah, and you're talking from an investor perspective or from an investee?
Well, I guess in our case, from someone raising money. So
Okay.
what are the questions I'm not going to ask because I just don't know or I'm scared?
Okay, great. I think it gets down to how comfortable do I have to feel about my business before I figure out how much money to raise. That's probably one of the hardest things. I always have a ton of consternation, even when a business is a $30 million business. I have a ton of consternation around going and raising money. It's a big deal. You are giving up business ownership. You are diluting your existing owners. be it founders, be it employees, be it other investors. So for me, the biggest thing is just really talking to people and going, how do I feel about how good our plans are? The other part of it is really saying, how do I find the investors? You know, I could give an entire talk on how do I find the right investor. There are so many of them out there. I was a co-founder in a technology business. I spent, and I've raised lots of money. I personally spent over 100 hours building out my own database and trying to reach out to investors for a first time, because there's so many of them out there, and it depends on what do they invest in, what's their criteria for investment, what's their return requirements. So I think really having that relationship with someone who's been through that fundraising and that has that, hey, I've got this database of potential investors, or hey, I know some good people you can go to, that's one of the biggest things. I will tell you the question you always need to be prepared to answer, and it's the best question that VCs can ask, and they barely ever ask it, which is, what are the 2 biggest risk factors in you hitting those numbers that you're showing me? They barely ever ask it, and it's the best one. So make sure that you know that answer. Don't offer it up, but make sure that you know that answer. What else?
Don't be shy, guys.
Go, Tony.
Hi, April.
Hi, Tony.
One quick point to what you were asking, Ben. I think that one very important question that you should ask as the person looking to raise is alignment. Mm-hmm. What is the investor after? Obviously, they're looking for a return, right? But what is your objective as the business owner? Mm-hmm. Do you have an exit? You know, but that actually brings me to another question for you, which is, can you help us understand the differences on VCs, venture capitals, and private equities, and the dynamics of those, specifically on what drives them and their return life cycle?
That's a great question. So when you talk about some of the investors, a lot of times we think about in the Series A, B, and C, we typically think of those as venture capitalists. So venture capitalists, and then once you get into the C's and maybe the D's, you start talking about growth investors. Those are people who are investing in the idea, they're investing in the team, they're investing in the market, and they believe that there's great potential for top-line growth. And so that's what they're investing in. They typically want a 3 to 5 year horizon on the return, and they typically want, a 5x return. That's what they want. Now, when you start talking about investors that are more focused on the cash flows of the business, those are a different set of investors. A lot of times, those later stage investors, they want you to be able to be cash flow positive. They still want some growth, but it's not as much about top line growth as it is what they call margin expansion. So margin expansion is important to them. The other thing that they'll typically look at doing is putting you together with other companies. They'll look at ways to leverage your business. They'll look at ways to leverage your investments that you've made, perhaps a penetration in a market or a customer base, and putting you together with other companies so that they can maximize that. The other thing you have to be really careful about is, what do they want to do with the management team? A lot of times, venture capitalists, again, are investing in that management team. It's not always the case later on. So they may look at, can we leverage this business but under this different leadership? A lot of times they'll actually pull out the founders, they'll pay off the founders so the founders no longer have ownership in it, and it's really turned over to those investors. So those are the things that I would look at. Any other questions? Yeah.
You had mentioned on one of your slides that the time to seek credit or debt is not debt, the credit line is early before you need it. So for a small services business, which has never needed any credit line at all, would you suggest establishing one? What would that look like for, you said you do services as well as high growth stuff.
I do.
April,
What would that look like, and is that recommended?
Yeah.
can you repeat that for the live stream?
I will. So the question is, I referenced saying getting debt in place early or getting a credit facility in place early. Would that be recommended for a services company, who has never needed to have that around? Absolutely. Let me tell you why. The market can tank at any time. The economy can tank at any time. It's really important, again, to get that in place when you don't need it. Now, a lot of that is dependent upon the banking relationships that you can drive and the predictability that your business has had and how much they're willing to put on the line from a facilities perspective. Services businesses is a little bit harder because typically for technology businesses, the collateral is the IP, the intellectual property that's built within the business. And so they can kind of stretch a little bit more on tech companies, but I've been able to get it for services companies too. It just depends on the maturity and the predictability of the business and what that underlying customer base is. So it's going to be much smaller for a services business, but I still believe that having that kind of fallback is really important because none of us ever know what's going to happen with a market perspective. It could be short term or it could be longer term, so you always want to make sure you can leverage it.
What's the instrument for that?
It could be an AR line, which it's not AR factoring, but it's basically you typically have, let's say you typically have $350,000 in accounts receivable. I'm going to loan you some portion of that AR. No, it's not on a specific, it's not that factoring. It's not going to be, oh, I just invoiced this and I'm going to get some cash right then. It's an AR facility. Sometimes you can just do a term line. In other words, I'll give you access, maybe on a services business, maybe I'll give you access to $250,000, maybe $150,000 on a services business. And it's just a term facility that you have to pay back in the future. You don't have to draw against it, but it's kind of out there. So those would be the things that I would recommend. You bet.
So every hour fundraising is an hour not working on product and an hour not out with customers. In your experience, how long does it take to raise a seed or an A round?
That is a great question, and I agree. It takes a lot of effort and time out of the business and can actually materially impact your business to the bad. So it's a really great question. And were you asking about a Series A?
Yep.
So Series A typically takes anywhere, the shortest I have ever seen it, ever, is 3 months. And that was like a miracle. Typical time from saying, I want to raise money to actually getting the money in the bank is 6 months or more. Now, you're not on the road that entire time, but different parts of the organization are going to be devoting time and effort, whether it's getting out on the road, doing what they call a road show, going out and visiting investors, whether it's getting your diligence together. So yes, they do a proctology exam on your entire business, so make sure you have some jelly ready. Not the kind of jelly they were talking about in the other presentation. Then there is literally negotiating through all the terms and conditions that are required for you to get that paper in place. So again, remember, plan for success, paper for failure. Papering for failure takes a lot of time. So that's a great question.
We have time for one more question. Or you can ask April after she leaves the stage.
Yes, you can always come ask me. I will tell you anything I can. All right, thank you all very much. I appreciate it.